This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello, listeners, and welcome to the IUX podcast, a part of Trade Alive, brought to you by IUX Education. Before we begin our charting analysis today, please note this important regulatory warning. Trading Forex and contracts for difference, or CFDs, involves a high level of risk and is speculative in nature. Trading with leverage can result in losing your money rapidly. In fact, 76% of retail investor accounts lose money when trading CFDs with this provider. You should carefully consider whether you understand how CFDs work, whether you can afford the high risk of losing your money, and whether leverage trading matches your financial objectives. Now, let us return to today's episode, where we help you explore the lives, lessons, and legacies of the world's greatest traders. Welcome to another episode of our ongoing exploration into the fascinating world of market structure and structural analysis. Today, we are embarking on a comprehensive journey to understand the foundational pillars of market observation. Whether you are observing equities, commodities, or foreign exchange, the principles we will discuss today remain a universal language. Our focus is on a topic that serves as the bedrock for observing historical price data, understanding and identifying the historical boundaries of price movement. Before we delve into the technicalities, let us take a moment to conceptualize what a financial market truly is. At its essence, a market can be viewed as an ongoing auction, a continuous negotiation between those who wish to acquire an asset and those who wish to distribute it. This negotiation leaves a visible trail of data, a historical footprint that we can study and learn from. Support and resistance represent fundamental concepts in technical analysis, reflecting the continuous interaction between supply and demand within financial markets. Support and resistance represent fundamental concepts in technical analysis, reflecting the continuous interaction between supply and demand within financial markets. Think of them as historical floors and ceilings, where market participants have previously shown significant interest. When we observe a chart, we are looking at the aggregated decisions of millions of participants. At its core, support is a price area where demand, buyers, has historically been strong enough to pause a downward price movement, acting as a supportive floor. Conversely, resistance is an area where supply, sellers, has historically paused an upward movement, forming a structural ceiling. Understanding these concepts provides a structured framework for observing the balance of market behavior. Let us expand on this idea of floors and ceilings. Imagine a commercial real estate market in a bustling city. If the price of office space drops to a certain level, businesses that were previously waiting on the sidelines may see value and begin acquiring leases. This influx of demand often pauses the decline in leasing prices. That level becomes a historical floor. On the other hand, if leasing prices soar to extraordinary heights, businesses may decide it is too costly and begin looking elsewhere, while current owners might look to sell their properties to capitalize on the high valuation. This sudden influx of supply creates a ceiling. Financial markets operate on this exact same principle, just at a much faster and more visible pace. The study of these price levels is primarily an exercise in recognizing historical patterns and human psychology expressed through market data. For instance, round numbers often act as natural psychological barriers where collective market decisions are frequently made. Consider how individuals naturally process numbers. We tend to gravitate toward even, whole figures like $50, $100, or $1,000. In the financial markets, these round numbers frequently align with areas where large volumes of limit orders are placed. This memory includes the essential principle of role reversal, or polarity, where a broken support level may naturally transform into a new resistance zone, and vice versa. Imagine a floor in a building. If you break through that floor and look up from the level below, that exact same structure has now become your ceiling. In market terms, an area that once harbored strong demand can, once decisively breached, become an area of concentrated supply. Approaching these concepts objectively allows individuals to construct a strong foundation for market analysis.
Instead of attempting to predict the future, the focus shifts to evaluating present market conditions based on established past data. The intention behind mastering this analytical tool is to foster a deeper comprehension of market dynamics, establishing the groundwork for learning how to draw support and resistance zones accurately. This educational pursuit equips individuals with the ability to observe market structures neutrally, recognizing that all market environments are subject to continuous change and adaptation. By studying how prices have behaved at specific junctures historically, and understanding that these interactions form broad zones rather than exact single price lines, analysts can build a more comprehensive and factual view of the market's overall context. This shift in perspective helps cultivate a more objective approach, reducing emotional guesswork and replacing it with a structured analysis of what has already transpired, allowing us to view historical data with greater clarity and a deep appreciation for the mechanics of supply and demand. Having established the philosophical and psychological foundation of these historical boundaries, we must now transition into the practical application. How do we translate this understanding onto a price chart? To move beyond basic observation, it is essential to explore the methodology of identifying these levels. A key aspect of market analysis is understanding how to draw support and resistance zones accurately. This is where many observers encounter a conceptual hurdle. It is common for individuals to open a charting platform, identify a previous peak, and draw a perfectly straight horizontal line across the screen. While this is a starting point, financial markets are highly dynamic, and price action rarely reacts to an exact single price point. Think of a bustling harbor. The tide does not stop at a single microscopic line painted on the dock. It ebbs and flows within a general area depending on the weather, the pull of the moon, and the wake of passing ships. Therefore, market analysts prefer to identify zones or areas rather than thin, singular lines. This approach accommodates natural volatility, helps observers account for potential false breakouts, where price briefly pierces a level before retreating, and respects the minor price fluctuations inherent in all trading environments. When learning how to draw support and resistance zones accurately, the initial step involves examining a chart on a higher time frame, such as a daily or weekly chart. Why is this so crucial? A widely recognized principle in technical analysis is that higher time frames generally provide a clearer macroscopic view, meaning the zones established on these charts carry more historical weight and structural reliability than those found on smaller timeframes. A zone that has maintained its structural integrity on a weekly chart represents the aggregated decisions of participants over months or even years. It reflects a much larger pool of capital and a much deeper psychological memory than a zone found on a 5-minute chart. The process consists of identifying major swing highs, peaks, and swing lows, troughs, where the price has historically shown significant reactions or periods of consolidation. When you look at a daily chart, you want to identify the most prominent turning points, the areas where the market made a very clear, visible decision to change direction. Once these major structural points are identified, how do we properly map them? A zone is typically drawn by encompassing both the wicks and the bodies of the candlesticks at these turning points. This is a critical distinction. The reasoning behind this method is that the wick represents the extreme of price exploration, while the body represents the consensus of where the price settled during that period. Let us visualize a hypothetical example. Imagine observing an asset that rallied upward, reached a high of $105, but by the end of the trading day, it closed at $100. The candle on your chart will have a body closing at $100 and a wick extending up to $105. That entire $5 range can be observed as a potential zone of resistance. By highlighting this entire area, one captures the complete region of historical interest. It encompasses both the absolute extreme where supply first entered, the top of the wick, and the area where the broader market agreed supply was dominant, the body. Furthermore, the structural significance of a zone correlates with the frequency of price interactions. When a market repeatedly visits a specific area and reverses, It underscores the historical relevance of that zone. However, we must view this objectively. While a zone tested multiple times clearly demonstrates its historical relevance, market mechanics suggest that repeated testing may eventually absorb the underlying supply or demand, which can lead to a structural break. Think of a stone repeatedly striking a piece of glass. While the glass may hold firm for the first few strikes, the constant interaction gradually weakens its structural integrity. Additionally, an area that has acted as both support and resistance at different times, demonstrating the principle of polarity, often referred to as a flip zone, is generally considered highly relevant. These flip zones are fascinating areas of market geometry. They show a clear historical agreement that a specific price area holds immense psychological and structural weight, serving as a boundary line that, once crossed, completely shifts the immediate market dynamic. Many analysts also observe trading volume when price approaches these zones, as an increase in volume can serve as data to confirm the zone's structural validity. If an asset approaches a historical documentation of a demand zone, and we observe a significant expansion in trading volume without the price breaking lower, it provides factual data suggesting that large-scale participants may be actively engaged in that area. In addition to horizontal levels, analysts observe the concept of dynamic and angled support and resistance. The market does not only move sideways, it trends. Trend lines are frequently drawn to connect ascending lows or descending highs, illustrating the structural boundaries of a current trend. These angled lines help observers frame the trajectory of momentum. Similarly, tools such as moving averages are utilized to visualize dynamic areas that evolve with the current market flow. Unlike a static horizontal zone that remains fixed at a specific price, a dynamic indicator adapts to the incoming data, providing a flowing, continuous reference point for historical average prices. Combining static horizontal zones, angled trend lines, and dynamic indicators can provide a comprehensive framework for observing potential market transitions. By layering these objective tools, an analyst can build a rich, detailed map of the market's landscape. It is crucial to view these zones not as impermeable barriers, but as areas of interest where one might objectively observe how the market chooses to behave next. They are not prediction tools. They are areas where we are simply paying close attention to the unfolding interaction between supply and demand. Phase 3. Synthesizing the framework. As we draw this comprehensive exploration to a close, it is important to reflect on the core philosophies we have discussed today. Market analysis is a journey of continuous learning, adaptation, and objective observation. At its core, understanding support and resistance is about observing the historical balance of supply and demand, where floors, support, and ceilings, resistance, reflect market psychology and price memory. We have explored how the markets are driven by the collective decisions of participants, often reacting to significant psychological barriers such as round numbers and respecting the historical significance of previous turning points. Because financial markets are highly dynamic, it is crucial to identify these areas as broader zones rather than exact singular lines, which helps accommodate natural volatility and false breakouts. We must always remember that the market is a fluid auction, not a rigid mathematical equation. Giving price the necessary room to breathe within a designated zone allows for a much more accurate and realistic reading of the environment. Accurately drawing these zones involves analyzing higher time frames for structural reliability and encompassing both candlestick wicks and bodies at major swing highs and lows. By starting with the macroscopic view on daily or weekly charts, we anchor our observations in significant, historically validated data before zooming in to observe the finer details. Furthermore, recognizing concepts like role reversal, polarity, and combining static horizontal zones with dynamic indicators, such as trend lines and moving averages, creates an objective framework for market analysis. This layered approach ensures that we are not looking at the market through a narrow lens, but rather observing the full spectrum of structural boundaries. Ultimately, mastering this methodology serves as an educational foundation, empowering individuals to evaluate present market structures factually rather than attempting to predict guaranteed future outcomes. The transition from seeking certainty to embracing probability is a significant milestone in any analytical journey. By focusing on what the data shows us, By respecting the zones, acknowledging the volume, and observing the reactions, we cultivate a calm, neutral, and highly structured approach to the financial markets. Thank you for joining me on this deep dive into market structure and structural mapping. I hope this discussion has provided you with a robust framework for your ongoing market observations. Before we conclude today's session, I would love to hear about your own experiences in mapping market structure. When you sit down to observe a chart, which type of zone do you find the most fascinating to watch? Are you more drawn to observing historical horizontal flip zones, or do you prefer tracking the flow of dynamic trend lines and moving averages? Please share your thoughts and analytical preferences in the comments below so we can continue to learn and explore these concepts together. If you found this educational episode valuable, feel free to like, subscribe, follow, and share it with others who are on their trading education journey. Please remember that the technical analyses and indicators discussed in this podcast are provided strictly for general educational and informational purposes. This content does not constitute personal investment, financial, legal, or tax advice, nor does it represent an offer or recommendation to buy or sell any asset class. Trading in financial markets carries substantial risk. Past performance is not a reliable indicator of future results, and all investment decisions remain your sole responsibility. Keep observing, keep learning, and I will see you in the next episode. Thank you for listening. See you in the next episode. Goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.